Let's just do crude oil first. All right, we'll just do this one here. From the 14th, we'll connect at 8:20. Okay, so we'll run market replay, Blackbird and market replay for this example from the 14th, today's the 15th, at 8:20. So you don't have to be connected to data, you can just disconnect. You want to download the market replay data from here, Tools, Historical Data. That opens the data window, and then load, get market replay, select the instrument and expiry, and we're doing the 14th, and download, and it'll tell you when it's done. So that's it, it's done, but you don't want to connect to market replay, especially for the ES, and try to get to that date with this workspace open. I have added in this workspace. There's one market replay for Forex, futures, and then one for stocks. Let's do crude now. So I want to open this one for the futures, which opens up this chart right here. So I've combined them all so you don't have to have a bunch of different workspaces for this for multiple markets. And if there's any market that you want to add to it, you can just add them here and apply a chart template. Like if I wanted to add, what was one we were talking about earlier? Like the FDAX, which I would need to update. I can add that, and then I have two chart templates, one for minute data and one for tick. You just want to make sure that you have one for each minute and tick so that market replay, NinjaTrader, can cycle through these charts without any indicators and then get to the date that you want to start at very quickly, and then you open up the TTP workspace. Okay, so I'll connect to the market replay connection after closing this workspace. And connect to the playback connection. And you see it connects pretty quickly like this, but wait for it to load. And I only have crude oil, so let's monitor these two here. So to get to the date that I want to start at, what time was it? 8:20. I right click on it and select go to, set the date here. '08. It's kind of tricky to deal with these. We'll set it to 8:20 and use the up arrow to change it to AM, and then click OK. And now it will load these two charts up to that time. It just takes a minute to get going. But if we were doing this directly on that TTP workspace, then it's going to have to cycle through all of those ticks for all of those charts and run all of the calculations for relative volume and BloodHound, those templates. Okay, and there we are. Now we're at 8:20. Just to check to make sure the prices are the same, 65, 65. Now I open up that crude oil workspace. Okay, and that's just going to take a minute to load this template. And then we'll actually remove that BloodHound template and add BlackBird. And I can do that just by using, applying a template. So right click on the chart, select templates and load. And this one right here, TTP entry. And this is the one that we'll add Blackbird to. So when you do that, obviously all the readers drop out of the reader manager. And then when we add Blackbird back, it'll repopulate with that list of readers. So we just want to make sure that all of the charts are at the same price. And then if they're not, you can just add a day or remove a day and reload it. Just click OK. And it'll straighten itself out. So that's the biggest problem with market replay. Getting to the date that you want to start at quickly, and then making sure that the tick data and the minute data are lined up. If they're not, sometimes you'll have just a single tick, like way up here, where the previous close was way down here. And then when you start, it doesn't build the charts properly. So as long as they're built properly and they're all aligned, then you should be good to go. You should have a lot better experience with it for sure. So I'm just right clicking on the chart now that I'm connected to data. You have to be connected to data to load a strategy, and you cannot have the market, or sorry, you can't have the chart trader enabled, which is this right here. That chart trader is on. Oh, it looks like you can in Ninja 8. Huh, yeah, I guess it does let you still add it, but maybe you just can't enable it. In Ninja 7, you can't. Yeah, it still lets you. So maybe it just drops it. But yeah, in Ninja 7, you can't have that chart trader on. So anyway, I'll just keep it off. BloodHound loads its own chart trader, so that's what we're going to use here. So this is where you add the file. You'll have to do this every time for every market because you can't use a chart template with a strategy. You can add it once and save it to the workspace, and then when you open it back up, it'll be there, and all you'll have to do is enable it. But you can't load a strategy from a chart template. See, Documents, Ninja 8, Templates, Blackbird. Of course, it will open the right folder, but then open that TTP folder, Volume Analyst. There's a set in here for backtesting, which we'll do one day next week when we release that fix for the row bars, whatever day that'll be, but it'll be next week. And then these are all the real-time templates. So I'm going to load for crude oil, Blackbird real-time. This is the 700th version. And then click OK. So this is the biggest, most important part of this, these two settings here. So if you're connected to the market replay connection, they call it playback now, because you can actually use historical data without having to download the market replay data. But I had an issue with that a while ago. I haven't tried it recently, but I always just use this market replay data. Sometimes it's a little bit different. The tick data especially can be different, but it's pretty decent. So this is the next major step here, calculate. Has to calculate on each tick. Each tick. And then this is where you enable it. And if you want the orders to exit right before the close, this is 30 seconds before the close, you can have that checked. I'm just going to uncheck it. The rest of these settings you can read about in their documentation on their site, which you'll be able to get to from the help button once we load this. So enabled, time and force, good till canceled. And show chart trader. You can start it auto-enabled on, but I wouldn't do that. And now it's building. So the first time that you enable Blackbird for each instance, each time you start up NinjaTrader, the very first time will take a little while because it's converting some of the UI, user interface stuff. So it takes a little bit. Most of the time it'll show that window that it's calculating or loading. But some people will think that it's frozen, but it's not. It's just the first time. It takes a little while. But then if we enabled it on another chart, another workspace, it would show up pretty quickly. Same thing with the settings window, which you'll see in a second. So it's loading. So it's going to load BloodHound here in the lower panel. Okay, so you'll see that it loads BloodHound, the template actually being used, up here at the top. And it loads it with no logic selected. Okay, so before you change it, I'll even let a tick or two come in here. Before you change it over to the entry or exit or whatever, come over here to the reader manager and make sure bulk notify is checked and recalculate all. Just takes a couple seconds. So now they are all for sure connected, and you'll see the historical signals after that. Most of the time, just connecting to the data feed will reconnect them and recalculate, but all the new incoming data will be fine. So then, once we have it all enabled, you can hit this auto disabled button, and that turns it on. And then you can actually control long or short here. So I didn't connect these trend definitions because I don't find them to be, I don't know, as good as they could be. And this is kind of the thing with automation. It's difficult to say the least, but then we are limited to just volume and a couple of indicators, whatever indicators we can put on this one chart, unless I want to build multiple time frames back here, which I don't want to do. It's just kind of problematic in multiple time frames. When working with multiple time frames directly in the strategy, you open it up to more potential crashes and errors, and most of which I'm pretty sure Jeremy's worked out with BloodHound and BlackBird, but still, anytime I can avoid using multiple time frames directly in BloodHound, I want to do that, which is why we made the reader system, so that we can access all of those signals from other charts without having to load those charts directly into BloodHound. All right, so just to show you around a little bit, you've got the entry, you've got exit 1 and exit 2. So for the real-time templates, let me show you. They're always going to look like a bar late, but that's because, and that's why we have one real-time and one backtesting, because the signal in real-time is actually fired at the open of that bar, which would be at the close of the previous bar. So if I show the entry logic here, because I'm adding in these couple of little price action conditions here, where I'm looking for the high greater than or equal to the previous high for a long, or the low less than or equal to the previous low for a short. At the same time, the close having to be greater than the previous high or less than the previous low. Because I'm requiring that, you could potentially get the signal, a little bit away from the swing low for a long or the swing high for a short. So I've limited it to a maximum of 6 bars from the most recent low or the most recent high. Okay, I'm wanting to, at least wait for a little bit of a move in favor of the signal before allowing it. But, this isn't perfect, and this isn't this isn't a perfect, reliable, fully automated entry that you can expect to make money on consistently. That's not what this is. This is more of piecing together a lot of different conditions that will oftentimes produce a swing high or low. But again, these are very fast charts. And this is for pretty fast day trading where you're going to get a lot of signals per day, more than would really be statistically viable for the number of bars created in a day. Usually when you get more than a certain number of signals per market per session, the odds of that actually being a successful or a profitable system go way down. So a typical automated system that would be profitable would not get that many signals per market per week even. This is not the end all be all for sure, but what is good about this for sure is the trailing stops, the rules that we have for that. So that's what we'll go over here in a second. So these are some trend definitions here that you could connect, which would eliminate some of the bad signals, which would obviously eliminate shorts if we're screaming to the upside, or eliminate longs if we're screaming to the downside, but they'll also filter out some good ones. So trend is kind of a funny thing where you can define it so many different ways that it's really more of a preference than anything else. And it depends upon the chart that you're using to define those rules. So there's the entry, and then there's exit 1 and exit 2. Now let me show you, let me turn this thing on here, and I'll show you the rest of this while it's building. I'll leave it enabled. Yeah. Okay, so there it is. So now let me explain what is happening here. So you see this? You see where it got filled? So it's not at the close of that bar, it's at the open of that bar. Because this is all real time, we're having to get the signal right when that next bar paints, which is why I had to displace it. And I'm kind of getting into some details that should be in a separate video, but the difference between the real time and the back testing is that 1 bar offset. So these couple of rules right here, this is for H means high, 1 means 1 bar ago, 2 means 2 bars ago. If this is over your head, don't worry about it. You don't need to know it just yet, but you will want to learn this stuff if you want to try to, develop your own stuff. And we'll go into detail about all of this in a separate recording, but it's displaced by 1 bar, which means here I have to set it to 2. If I set it to 1, these little long and short look back processing options or properties will hide, they go away. But if you set it to 2, 1 just means the current bar essentially. If you set it to 2, then you're looking at the previous bar, and if you're using price, high or low, then you can use the highest high, which would be the max between the current and the previous bar, or the lowest high. Okay, if you just want to use the previous bar's value without filtering it by min or max or average, you just set it to single value. So this is simply displacing the bar by 1. And that's the only difference between the real time and the back testing. So the back testing version of this, the signal would be on that bar, the previous bar, which would make the back testing results fire or fill the entry at the same exact price that it's getting filled in real time. So for a back test, if the signal is on that previous bar, then the back test fills the order at the open of the next bar, which is exactly what it does in real time. So that's why the 1 bar offset and the difference between the back testing and the real time. So sometimes, you may have a really giant bar here that you get the BloodHound signal on, but it's actually filling at the open of that bar in real time, just so you know. All right, so here, these orders, they're telling you what they're going in based on. I'm not using the average true range, but I'm using just the average range. So internally, and now I'm opening up the order settings for Blackbird. The first time you open this, because it's converting the graphics, it takes a little bit, but then the next time you open it, it's instant. So the first order set A, is going in at 15 times the average range, and the value that it's using there is this center value here, which is 100 period average range. 100 period average range. So this is order set A, order set B, and I'm putting them pretty far out. It doesn't really look that far out just looking at the chart, but it really is. It's over 80 ticks, it looks like, or 70 ticks. This is the name 15 times AR, average range, rather than average true range. And I'm setting that using this AR. This is our little indicator. It's used inside of everything that we do. And it's right there. So you got the ATR, which is the Wells Wilder average true range, which will include the gap between the open and the next bar's close, or high or low, depending upon the extreme of that bar. This is just a simple average range, and it's set to a period of 100 right here, 100, and it's offset by 15 multiples of that. So there, it was at 6 ticks. Oh, and by the way, this is average range plus 1 tick, because, for one thing, you can't divide by 0. So what do you do for a bar that has the high and the low is the same price? Should that be 0? Is that 0 ticks, or is it 1 tick? So if it's only got 1 tick, 1 price for both the high and the low are the same price, doesn't make sense that it should be 0, but yet that's the way everybody's built them. Well, except for Harry, the guy that wrote some of these trailing stops, and the guy that owns the lizardindicators.com. So yeah, if it's got the same high and the same low, that's not 0 ticks, that's a 1 tick range, because it has 1 price, right? So this is the high minus the low plus 1, and it's 100 period SMA of that value. So an ATR here would show 5. Might be a little bit different because the ATR has a couple of weird little things in it, maybe whatever, 5.1 or 4.8 or something like that. But here it's always going to be 1 tick larger than the actual ATR, for a good reason that I just showed you. So 6 ticks times 15, that's what places the initial placement of that target. And I keep it far enough away so that the trailing stops will actually take this out. Now, I've said in the past that if you're consistently exiting on trailing stops, then you're never actually getting the full potential of the trade, which is maybe a bad way to describe it, but the maximum favorable excursion, which would be the furthest that price had moved in favor of the trade when you close it. For a short, I would be getting out as it would be coming down. If I did that at the maximum favorable excursion, then the exit efficiency of that order would be 100%. But if I'm getting out after it turns back up on a trailing stop, then my exit efficiency is, whatever percentage from my entry to the exit minus the distance from the exit to the maximum favorable excursion. So if it retraced 25%, then my exit efficiency would be 75% for that one order. So anytime your exit efficiency is consistently less than 100, maybe that's not the right number to use. You're consistently getting out after it's moving back against the trade, and you're not getting out with what the full potential would have been before the exit, your numbers are going to be I mean, everything is situational, but they'll be more mediocre than they would have been otherwise. But there's a flip side to that. If you're consistently getting out maybe with 100% exit efficiency, where you're getting out as it's going in favor of the trade, if you're doing that too soon without getting at least a large percentage or at least a multiple, let's say, of 2 or more, the amount that you're risking, then your win percentage of winning trades needs to be higher and higher and higher. So you want to consistently make more than you're risking, and you want to try to get a good exit efficiency. If you're only using trailing stops to exit, it's going to be pretty hard to get a good exit efficiency, but you can potentially get more profit out of the trade than you're risking. So I'm trying to kind of meet it in the middle here where, yeah, it's going to get out on a trailing stop, but once a couple of things happen, it's going to tighten that trailing stop up pretty tight. And those are the rules that we'll cover here in a second. So in the future, I am going to continue to make these better, and I'm never going to say that it's a fully automated system because it's not, but because of legal reasons. I'm not a CTA. I'm not licensed. I'm not a trade calling service. I'm not advising you to run this as an automated system. This is not investment advice. Disclaimer, disclaimer, hello. You should be using this with a simulated account, not live money. But I will be continuing to improve this, and especially improving the trailing stops and targets. So the fully automated entry aspect of it, I'm really only going to take so far, but it will improve for sure. But as far as the exits and the trailing stops and targets, those I would say are more important to the health of your account anyway, just for ensuring against completely blowing up your account or losing too much money too quickly. Like I've talked to some guys that want to use 100, 200 to 1, what's the word I'm looking for? Leverage. So maybe they've got a couple of $1,000s in the account, but they want to trade like they have a couple of $100,000. Well, there's no faster and more absolute way of blowing an account than doing that. So if you're over leveraging and you think you're going to somehow make this work, guess again, because you're not. You'd be the first guy to ever do it if you did. Just be reasonable about this. I don't want to keep harping on this, but I mean, have some sense, be reasonable, at least learn how to use it and understand it, and do all of that in sim and trade sim until you can make money consistently. Don't blow your account and then, say that, oh, I said it was going to make money on a autopilot and you're going to be rich, because I would never say that. That's ridiculous. But here we've got 4 trailing stop rules for order set A, and here we have 5 for order set B. So each one will go to break even after a certain, and each one of these has a delay. Let me just explain the way BlackBird has laid all, Jeremy has laid all this out in BlackBird. You can name it, obviously. You have the initial delay when, after how many bars or how many ticks or seconds, ticks against the direction, ticks in favor, or any combination of those where all events must be met or the first one must be met. That's the initial delay that has to be met before the trigger is possible. Right? So each one of these has an initial delay, I think, of 5 or 8 bars. I think the other one is maybe a little bit more, 15 bars for this one. There's no delay for this one, 10, 15, 5. After the delay is met, then the trigger will determine when this trailing rule will go into effect, when it will actually start performing its action. And the action is defined here. So you can trigger based on price versus indicator. I think this needs to be renamed just input versus input, because you don't have to use price, but you could use an indicator, a swing, linear regression channel. So it's really not price versus indicator, but anything versus anything. So it could be indicator versus indicator, indicator versus price, whatever, multiple inputs. I think it can even be another instrument using their SI chameleon, they call it, where you can actually load another instrument at a same time frame or different time frame. So you can do quite literally anything that you can think of, you can do with this, which is exceptional that we can do all of this with just simple point and click and zero programming. I mean, it's pretty amazing, right? I don't think I need to say that more than once. So this is looking at a high or low break of 6 times the average range. So if the initial stop is going in at 3 times the average range, and this is kind of a random thing, but I mean, it is based on 2 times what's being risked. So once we break that 6 times the average range profit, and this is how you determine profit, which is the OCO order, the order cancels order entry price. That just means it's this stop is tied to that entry. Once it moves 6 times the average range, which is a 100 period average range, just like it is for the initial placement of the stop, then the trailing to break even rule will go in. I have it set to repeat twice, but really it doesn't need to repeat. I just have that in there as kind of a fail safe just to make sure in case, one of these happens to fire at the same exact millisecond, or maybe another instance, that it would get triggered again, just in case. I don't even think that's a real issue, but I thought about it, so I added it. This will move the order to 1 tick better than your entry price, so break even plus 1. And these stops can only move in favor of the trade with direction only. And that will keep the possibility of somehow a trailing stop for a short moving up, which, if that's possible in your setup, then you could have one that just, never gets hit. And then what's the sense, right? What's the point? So this is only with direction. Now the targets, when I get the market geometry stuff with the toolbar here for Ninja 8, and we're able to access these areas like we can in Ninja 7, then we'll be able to get pretty sophisticated with what we can do here. So I'm actually adding these back into the templates for NinjaTrader 7 for the Master Suite owners, not for the Volume Analyst for Ninja 7, for the Master Suite templates. And then, we'll be able to do some pretty cool stuff in 7 next week. But until we have all that for Ninja 8, this is really, I wouldn't say it's the best we can do, but it's a pretty good start. Anyway, I was talking about trailing the target. So the target trailing, I would allow both directions, with the trade or against the trade. Against the trade, to tighten the target. Let me just tell you an idea real quick that I've written down anyway. So one of the trailing rules here, kind of jumping ahead, but I want to say this while I'm thinking about it. One of the trailing rules, the trigger, is a logic template, BloodHound logic, which is actually part of this template here. So this template, which is what you see there, has 3 drop-down logic templates here. Logic tabs, I guess you would call it. 3 different logic boards. One is for the entry, obviously, which I have set to entry. If I set the exit to one of these exits, the minute one of those exit signals fired, it would close that order. Okay, the way that I'm envisioning this, if not the next version, then the version after that, I think the next version will have some beefed up trailing stops and targets. But the version after that, I'll have these entries, which inside of that template, I'm bouncing around here, but you need to understand this before I try to explain it. These are essentially 5 sets of rules, 5 independent sets of rules here. Essentially each one of these and nodes, and just means both, or means either. So each one of these and nodes is like a separate trade, more or less. Separate set of conditions. Separate combination of conditions. I'm going to have it to where each one of these will be in a separate template up here at the top, and you can load as many templates as you want. I'll probably group them, maybe 2 to a template or something like that. And then each order set will have one specific entry, or 2, as opposed to 5 in each. And then, I'll have it with the ability to scale in, add to a position if you get another signal. There's a lot of stuff we can do with this. It's really endless what we can do. I've actually been working with it for a while, so there's a lot of stuff we could do that I haven't done yet. But at any rate, one of the things that I want to do is, rather than making it to where this one is going to close the trade immediately when that exit signal fires, which is what it would do if I set it here, I'm rather using that exit template as a trailing stop rule here. And I know you're probably getting lost if this is brand new to you. Even if it's not, I imagine it's not easy to follow, but we can add in logic templates as trailing stop triggers, and you can actually grab whatever template is up here in the top. So you could have one template with, a bunch of little drop-down logic tabs, or you could have multiple templates, each with only one logic tab, or vice versa, or both. So I'm using it with all 3 in that one, which I'm kind of thinking is more efficient. I can't prove that yet, but it makes, it's reasonable. So anyway, when that fires, rather than closing the trade immediately, it's going to move the order to just behind, for a short, the highest high of the past. It says 4, but it's really 3 bars, because the number 1 is including the current bar. So the highest high of the past 3 bars at half of an average range. I'm trying to keep everything average range so that when we're moving this from futures to stocks to Forex, you've got wildly different tick values. So if it's all average range, then it can at least adapt to the market. So yeah, when this one fires, this is for order set A. Order set A is a little tighter. It goes in at 3 times the average range, which for this one would be 18 ticks. And then order set B is at 5 times the average range. So for order set A, exit 1 will trigger that trailing stop to tighten up very quick, very tight to price. And then at the same time, what I'm going to add, this is what I was kind of getting at, adding a trailing rule for the target, where I'm actually allowing the target to move against the trade. So it would basically kind of bracket it in where, let's say that it came down here. I kind of need a drawing object here. Let's just say that it came down to here, and then we get the exit signal. Let's say the exit signal fired right there. Okay. then I would have that target move up to maybe offset 2 average bar lengths to see if it will actually make it to the target after that exit signal, because sometimes these exit signals will be a couple of bars before the final swing high or low. And then that stop will tighten up, like I said, to the highest high of the past 3 bars, offset a little bit to right here, and then it will trail with each new bar the highest high of the past 3 bars, but you'll have a better chance of actually hitting the target before that stop is taken out. You see what I mean? So I'm going to make it to where these targets will actually tighten up as well, but still give it a little bit more room. So rather than closing the trade instantly with that exit, I want to give it some room to try to squeeze a little bit more of the trade potential out of it. See what I'm saying? Does that make sense? So it's all logical, but I've got to run it in market replay for a while. It's one thing doing this manually, but now trying to program it for better efficiency and actually squeezing more out of the trade. I'm considering a lot of new things that I didn't really have, or well, haven't really deeply thought about yet. So it's probably going to take me a few months to get some real stats out of market replay, but I've got another computer set up now to let it run in the background while I'm doing everything else, while I'm running the trading room and designing and all that. So we should have some pretty interesting stats here soon, and then we'll at least have a great set of trade management rules, which I think it's more important than the actual entry. How you manage the trade, the actual exit is much more important. I know some people would argue with that, but obviously where you're getting out is where you're locking in how much you made or lost, right? So, all right. Let me just cover a little bit more about this, and then we'll let it run here. That one will be allowed to fire after a delay of 8 bars and 15 ticks in the direction. What it's going to do here is if it breaks this swing low, it's going to tighten up the stop. So anytime a major swing high or low is broken, that's one of the, in all the back testing that I've done and all the systems and stuff that I've built for other people, working with, as many different exits as you could possibly think of. One of the ones that consistently tested better than any, one of the few that would actually yield a back test with positive results without any optimization, would be this simple exit of a major swing high or low break. So a lot of the breaks of highs and lows people call them fake out breakouts, but a lot of them are just simply, it's moving back through that recent area where you had demand coming in at a low, but now it's moving back into that low with less momentum. So you're sometimes obviously setting up a volume divergence there, or at least momentum divergence there. And you just kind of break that low a little bit and then reverse. Even though this is a super fast chart, I mean, it's a 30-second chart. This exit, or at least initiate a tighter trail upon a break of a swing high or low, is one of the better things that we can add. So that's got to be in there. So I've got that in there to at least tighten up behind this volatility stop, this Wells Wilder ATR stop. But I'm not using ATR, I'm using average range plus 1 tick. You could use ticks in that as well, or ATR, but the way that I have it set up is like this, so that everything is consistent and everything is a 100 period average range, and that will always be this value right here in the center. Of these 3, you've got a 20 period average range, a 100 period average range, and a 500 period average range. The largest one will be red, the smallest one will be kind of grayed out a little bit, and then the middle one, the one in between the high and the low, will be silver. but the one in the middle, horizontally, is the 100 period average range, okay? So this one is going to initiate that volatility stop. Both of these, okay, listen, follow me here. I'm right. I have all this in a, well, I haven't finished it, but it's in a diagram. It's in a visual diagram. A lot of people are, learn better visually. So I've got it as a kind of a nice, easy to understand and follow flow chart. This logic signal, which is an exit signal from BloodHound, which means if you get that, then you've got some pretty significant signals in the volume on multiple charts. So if you get that, then of course you want to tighten that stop up, and this will tighten it up behind the highest high or lowest low of the past 3 bars, 4 including the current. Okay, and similarly, if you break a swing high or low, it's also going to tighten it up behind the highest high or low of the past 5 bars. Because this is a little bit more of a random signal, just a simple break of a high or low, maybe it's a breakout and it's actually about to start running, There's no volume involved here. I'm giving it a little bit more room, 5 bars, which is really 4, so just an extra bar. It's not a whole lot, but it's a little bit extra room, so it'll keep going. And then if you get the logic signal after that, then it'll tighten up a little tighter. Okay. I know, again, this is hard to follow probably because I'm just kind of throwing a bunch of info at you and you can't really see it listed. But when you have the flow chart, it'll be a lot easier to see with some screenshots as well. So this is the one that will tighten up behind the actual volatility stop. So I'm using this volatility stop for order set A, but I'm actually using the larger swing highs and lows for this same rule in order set B. So order set B, I'm trying to reach a further target. I've got a little bit larger risk on it, and I've got a little stricter or a bit more stricter rules for the exit for the logic. So order set B has a bit more room. Call it a runner if you want. It's just trying to get a little bit more out of the trade. So order set A will tighten up behind that volatility stop once it flips. So right now it hasn't flipped, but you'll see when this bar closes, unless we get a retracement, that volatility stop will flip and it'll start plotting up here, green. See, it's kind of pale red there. It'll start plotting up top here. You can kind of see the underside of it there. It'll do that up here. Order set A will tighten up to that, it looks like, first. So it depends on how long it's going to go sideways after the entry, whether you go to break even at all. It's kind of a 50-50. Sometimes you'll go to break even first, and then you'll tighten up behind the volatility stop. Sometimes you won't go to break even at all and just tighten up behind the volatility stop, or immediately break a swing high or low for a small retracement like this is, where the swing low is actually pretty tight, pretty close. And you just immediately tighten it up. I say immediately, but you know what I mean, within 10 or 15 bars of the entry. So, all right, I'm talking too much here. Let's just kind of let it go and see what happens, and then I'll explain what's happening. A lot of time and thought went into this, if you can't tell. A lot of trial and error. Okay, so there we just tightened up behind that volatility stop. Oh, one more thing. This is important here. So pay attention real quick. You have all sorts of money management, risk management, position sizing. I've enabled some of that to kind of, I don't know if I should say to force you to learn it, but to show you that it's there, and to, I guess, to force myself to teach you about it. You've got under you have under money management, the size of the account, which I imagine he's going to be tying directly to the account, and you'll be able to select the account via drop down here instead of actually having to set a number. And then how much you want to risk per trade, per the size of your account, or per a fixed amount. So maybe you want $500 per trade, or whatever. You've got a watermark where once you hit that mark, or once you've made a certain amount, then you cannot lose more than a certain amount. You've got that, which I don't have enabled. You have max, you got so much. I'm not going to try to go over all this stuff. It really take me an hour to go through all this. But you do have minimum, maximum reward to risk ratio, which doesn't affect us because the stops and targets are at fixed multiples of the average range. So by definition, the first target is at 5 times the risk of the first exit, first stop. And so each of these are at 5 times the initial placement. Okay, to give it at least room enough to possibly make it to 5 times the average range, which is, 5 times the amount risked, which is not as uncommon as you might think. I can't remember. I'll have to go back and look at the metrics again, but it was something like 10% of my trades made about 90% of the account. And those 10% trades, the 10 out of every 100 trades, were well over 8-to-1 reward to risk. Some of them were like 20, 25, 30-to-1. So, I would take a lot of break evens. I think by the end of it, my winning percentage was less than 50. I think it was like 49 or 48 or something like that, percentage winning trades. But the majority of the money that I actually earned, what grew the account, was a very small percentage of those trades. And those trades had very high R multiples. They made much, much more than they risked. So this limits that. This limits the possibility of getting some of those runners. But in order to get some of those runners, you have to hold through some pretty incredible retracements sometimes. And knowing when to do that and when not to do that, or I shouldn't say knowing, because you never know anything. You never know what's going to happen next. Even though we all want a crystal ball, we don't have one. So a lot of that was based on trend channels on larger charts and just Elliott wave to some extent, having an idea as to where the next big move would likely take us. So we don't really have that ability with such a small set of charts. The largest chart is a 4-minute chart, and without the market geometry. So, I have to put in, long story short, I have to put in a fixed target initially, and I'm just doing that at 5 times the risk. That's the way it is for now. But here, I'm allowing upscaling of the orders, the number of contracts. This is where position sizing comes in. And of course, that's tied to money management. Your position sizing is a part of the money management, and that's this trade fit functionality he's got. Trade fit functionality he's got built into there. All right, so because I'm allowing 2% to be risked on each trade, and I'm setting this at 45, I set it to 45 and 2 so that you would be able to see it change out the number of contracts used or placed or entered or whatever for order set A and B. Whereas normally, if I didn't have that, if I unchecked this and didn't allow upscaling, which means increasing the contract size, the number of contracts, which, by the way, you have to do for Forex and stocks if you want to actually, trade the account properly. So not as a big deal for a smaller account with futures, because you're kind of limited anyway because of the value of each contract is so high that you're kind of limited in what you can do. But I have it set to allow up to 3. And if I had this set to balanced, it would see how it put 3 on order set A and only 1 on B? If I put it to balanced for A and balanced for B, then it would have been 2 and 2. Okay, but I'm allowing some flexibility, and whether that extra contract goes to A or B, I don't have a clear definition as to why it would go to B one time and then A another. But I'll have to ask Jeremy about that. But anyhow, beyond that, beyond allowing the upscaling and the allowable number of contracts so that it's a maximum of no more than 6, 3 for B, 3 for A, and then how those are split between A or B. Beyond that, you can constrain. You see how incredibly, talk about thinking of every single thing. It's really just endless here. I feel like I'm just saying too much in one recording, but anyway, you also have minimum profit distance and ticks, maximum profit distance, minimum stop, minimum or maximum stop. So because we're doing everything in average range, for futures especially, I have set these minimums and maximums. So order set A cannot be smaller than 9 ticks for the stop loss, but it can also not be larger than 18. See, this one was 6 times 3, so this one was 18. So if that average range would have been 8 ticks, it would have tried to put it in at 24 ticks. And I'm not having that. 18 ticks is kind of big enough as it is. Now, in the future, I'll also be able to attach that stop for the initial placement behind the actual swing. If there's a swing nearby and it's close enough and it meets these money management rules, then I'll put the stop behind it to where I can get the stop tighter, closer to the entry, and not have to risk as much. You see, there's all sorts of different things I can do to kind of minimize risk and maximize potential reward. I think I've got a pretty good start in here. This is just a heck of a program. It's really I can't say enough about it. But the minimum profit target is always going to be 36. Maximum would be 72. So this is order set A, which is tighter. So less risk, less potential profit. Order set B is looking for larger. So therefore, the maximums are larger and the minimums are larger. So this one, rather than being 9, it's 15. And these are multiples of the ratios between the two. So it makes logical sense. I'm not going to get into it right now, but I'll do that in a diagram. What else? I think that's probably enough. Let's get on with it here. It's going to act like I just changed the settings. So I think when I turn it back on, it'll say new settings will take effect. Yeah, but I didn't actually change anything. Yeah, I guess I did. Did I make them balanced? I think I did make it balanced. So it would split the contracts evenly. But here you see it's trailing behind. This is order set A now. It's trailing behind that volatility stop at 1 times the average range. And I'm doing that rather than ticks because the number of ticks for Forex or stocks is wildly different. Forex is huge, which is why the values of the charts are so so much different on Forex. All right, so now it's pulling back a little bit. Yeah, my pleasure, Bob. I've been making promises that are difficult to keep. I don't know why I'm like that. I guess I feel like, well, I feel like I owe you guys because I do. I mean, I've only been able to keep doing this because you guys are paying these dudes salaries. So somebody's got to. So I want to give you, you know, I want to do right by you. But I think I take it to extremes and I worry too much. It's turning me gray. I'm almost completely gray, by the way. I wasn't 3 years ago. You see how it's tightening up now? So that was probably, here, let's pause it. That was probably one of these exits here. Well, it had to be the exit 1 for order set A. No, sorry, it broke the swing too, right? It broke through that swing. So that would have tightened it up behind the highest high of the past 5 bars. And then if we get exit 1, which we just got, now it's going to tighten up behind the highest high of the past 3, you see. It'll tighten up behind this little high now. And now this one is going to break even because it's 10 times the average range. Once it goes a certain distance beyond that swing low, yeah, this is a good one. This is a good one. Spent a lot of time thinking about this one here. So once we've had a pretty decisive break of that swing, in this case, the swing low for a short, see this opposite swing rule here? So once we get a full bar at 3 times the average range, which is the initial risk on order set A over here, once we get 3 times the average range beyond that risk, then I'm tightening up order set B behind that swing low, actually, but allowing enough room for it to come back. And you know how sometimes it'll break a swing low, pull back to the underside of it, and then go. So I'm allowing enough room for that. Yeah, I'm allowing enough room for that. But yeah, it's moving it to 1 times the average range, the opposite side of that swing. So that's why I'm calling it opposite swing, because it's actually a swing low for a short trade. Whereas before, it would be trailing. So if we had a retracement here and we didn't break 3 times the average range below that swing low and we got a retracement, then once the new swing high was found by the the swings indicator, the swings highs lows indicator, that green line there, once it would move down, that stop would trail behind it until either exit 2 fired or until we broke far enough below that swing low. So it's a pretty good set of rules here. What was that? That was order set A. Hang on a second. What happened? Oh, yeah, that's the, this is 25 times initial placement, the average range. That should be 16 or 17 times the average range. Yeah, that should be it. So 92 ticks, new swings, volatility stop. 15 times, okay. Yeah, so once it reaches 15 times the average range in profit, I'm risking 5 times the average range initially. The initial placement of the target is 25. Once we have 15, which is basically 20 times the average range from the initial placement of the stop, there's a method to the madness, but I'm not going to try to explain every detail of it. Once it hits 15 times the average range in profit, once it does that, then it's going to tighten up that stop rather than offset behind the volatility stop and 1 bar back. It's going to tighten up the stop to the actual volatility stop. You see how it's right on top of that green line there? This ended up being a pretty nice one. You see how I'm trying to squeeze as much out of it as I possibly can?